Nilesh Shah, founder and CIO of Envision Capital, now joining in. Hi Nilesh, good morning. It's Amina joining in. Just a quick reaction post the budget. Are you impressed? Are you disappointed? Are you indifferent? And are you back to business today?
It surely is always back to business at any point of time. So I think it was an important event. The big positive or the big takeaway of the budget is that it really focuses on the real economy. The fact that it reaffirms a higher allocation to infrastructure, it still reaffirms a path which is investment-led to continue to ensure that the economy sustains a high growth rate. Huge amount of focus on urban housing, energy, renewables. So I think these are some of the great takeaways which I believe will help the economy to sustain the high single-digit growth and retain its status as the world's fastest growing economy. So I think that's really the big part of it. The changes in the tax laws on capital gains essentially are a tad dampening, but I guess it's more to kind of align the tax rates on different asset classes and to kind of simplify the overall tax structure. So overall, maybe in the short term, that's a bit of a sentiment dampener, but I guess directionally, it's probably the right thing to do. So
Sure.
On the whole, very good, very positive. And yeah, I think this just reaffirms the long-term potential of the economy and the ability of our equity markets to continue to outperform global markets.
Nilesh, given that all the steps taken wasn't to please a short-term trader, was to, retain sticky money, locally draw some FDI in, so much simplification, and all of it seems like more of a long-term 5-year game plan, right? Now, if you keep that in perspective, the budget, of course, is behind us. Do we now shift gears to earnings, macros, rate cuts? Is that really what business is about right now? I mean, you're still going out there and focusing on those other important parameters beyond the budget?
Absolutely, Samina. Clearly, India remains a very attractive fundamental bottom-up market, while the macros have been relatively benign. But there's a lot of interesting stuff happening in terms of micros, in terms of individual businesses, individual companies, each of them charting their own growth trajectory and making the most of all the reforms that have been happening over the years in India. So I think clearly remain very, very bottom-up focused, looking at individual companies, monitoring the earnings season very well, and seeing whether your existing investments continue to reaffirm the investment thesis and continuing to scout for newer ideas. So I think on the whole, yes, it's back to business, back to earnings.
All right, back to earnings. On that note, Nilesh, good morning, Tamanna here. You think, so two-part question. First, do you think that we're going to see the aftershocks of the long-term capital gains tax tremor in markets today? Or do you think we'll get over it perhaps by midday or end of day? And second thing, when we put the focus back on earnings, what are you seeing? Are you seeing a picture that is perhaps not as rosy as you would have hoped?
Yeah, I guess the long-term capital gains impact has already been, it happened on an intra-day basis, pretty much like what we had last month in terms of the election result outcome, and that came as a kind of a knee-jerk reaction. I think something similar happened yesterday. So going forward, I don't think the direction of the markets is going to get too impacted with the tax changes. It's going to be now entirely driven by the earnings, the valuations, and of all the global and macro events, it's going to be rate cuts in terms of what the US Fed does with rate cuts and how soon the Reserve Bank of India will kind of resort to a rate cut. I think these are some of the things which will determine the course of the markets.
So rate cuts might be in play next. In terms of this, do you see now a period going forward, Nilesh, where we might not see too much action, a bit of sector rotation? And if so, what would be the strategy here?
Surely sector rotation is overdue. We've seen some really strong performance coming in from the railways, the defense, and the capital goods space. I clearly believe that you are going to see some money being taken off the table, some profit booking happening. I think that's a space where investors have gone in and gushed in with their allocations. So you're going to see some kind of trimming, pruning, or maybe in some cases exit as well from those kind of sectors. and it's going to be back to premiumization, discretionary consumer spending, some of the financials, fintechs, online platforms, and the tier 2 technology services companies which are doing very specialized niche work. So clearly seeing the market kind of getting back its focus into those sectors, these kind of sectors. You could call them as a bit defensive, but I clearly believe that there's kind of significant amount of growth happening there, and I expect the markets to kind of realign the allocations.
Okay. By the way, the pre-open rates have settled as we speak, and it's a flattish start to the markets, maybe pull up 0.14%. IT banking is maybe a bit hit, about a third, 0.23%. Just want to mark Bajaj Finance and see if that is taking a bit of a knock on the higher credit costs and some of the brokerage cuts that have come in. Not really a knock, just about 1.5%. Suzlon is perking up yet again, so that is doing okay. And there are a few stocks from the fertilizer space which is doing okay. But MGL, Castrol, a couple of others have come off. Nilesh, good morning. Is the 4.9% fisc deficit number the biggest positive of the budget, or is there something else that stood out as well as a big shining positive?
So Neeraj, there are a few. I think clearly the fiscal deficit going at 4.9% and projected to be at, or estimated to be at 4.5% for the next financial year, I clearly believe is the single biggest kind of highlight of the budget. I totally agree with that. This, apart from, of course, local investors and many of the other constituents, clearly international investors do look at this data point very closely. So I think that's a big takeaway. And this aspect, which reflects fiscal consolidation and a glide towards fiscal discipline, that plus essentially the opening up of the Indian bond markets for international investors, and then a possible rate cut, I think on the whole is likely to attract a lot more of capital into the Indian economy. So I clearly believe that's going to be the big takeaway. The second is a reaffirmation of that 3.4% spending or investment on infrastructure as a percentage of the GDP. That continues to be, again, the second most important kind of thing of this budget. The third is, while we have talked about some of the dampeners on the tax structure, but the other positive has been the cut in tax rates for foreign establishments from 40% to 35%. Again, I think is a step towards making India an even more attractive investment destination for global investors. So I clearly think these have been some of the big highlights of the union budget.
Okay. And the other question, Nilesh, is because I distinctly remember we spoke about this. We're just 2 minutes away from market open, Nilesh, so a quick one. But this a lot of talk around why the capex wasn't increased. Does the country have the capacity to absorb a higher capex number because it's only 8 months left in the financial? And therefore, is that a negative for the capex exposed sectors, or you don't think so?
No, I don't think so, Neeraj, because the Q1 was relatively soft for many of them. So I clearly believe that a lot of the kind of lagging behind in Q1 will get taken care of in the next 3 quarters from here. So I wouldn't be too worried about that.
Quick take, Nilesh, just before we get into the market open, on whether you would be sitting on the sidelines for the next few days, or you're looking at opportunities?
Not really. I think we continue to scout for opportunities on a day in, day out basis. So honestly, there's no question of sitting on the sidelines. We remain proactive with our portfolios and keep scouting around for newer ideas.
Ideas that are on the radar for you at this stage. You want to tell us what is it that you're watching out for?
So I think in the last couple of days, the renewable companies, the wind power companies, companies which provide the equipment for wind generation energy have come out with good numbers. It seems to be a very, very interesting space. So far, the incremental investments in the wind sector have started to pick up, but still are obviously not going full throttle. We expect a lot of momentum to pick up over the next maybe medium term. So clearly looks like that the outlook for some of the wind equipment companies seems to be kind of getting better and very robust and is becoming a source for allocating incremental capital.
And Nilesh, while I want to talk to you about those wind equipment manufacturers, a quick question on this this staples trade, right? Yes, currently it could well be people who are making money on the budget trade, booking profits also, but a 5% on Dabur is not just ordinary profit booking. My question is, over a 9-12 month period, do staples provide a good option, or are valuations baking in any kind of positives that come in from a consumption, probable consumption uptick?
So Neeraj, clearly structurally, we aren't very positive on the consumer staple space. Structurally, we like the premiumization story. We like the discretionary spending. We like pockets of consumption where higher aspirations are going to drive demand and where penetration levels are yet way low. Versus that, consumer staples, especially the ones who are basically selling soaps and shampoos, those are not the kind of favored bets as far as our portfolio strategy goes. And if at all, they could just be basically defensive, safe havens. If there were to be volatility in the markets, maybe people might just flock to them, but unlikely that they're going to grow in double digits. Even if you look at the results which have come out over the last maybe 2-3 days, the growth rates have been in low single digits. The only caveat or the saving grace for them could be a margin expansion. If crude oil prices were to head lower, that could drive their gross margins and therefore their net earnings. But that's about it. But if you're really betting on demand, if you're really betting on growth, then there are many better kind of opportunities in the overall consumption basket.
Nilesh, just a question on the big picture over here, because this budget is also being seen as laying the roadmap for what the government wants to do ahead, and the push on renewables, alternate energy continues, right? Unabated, though they're not fat allocations this time round. Borosil Renewable is showing that. Are any of these stories something that you are looking at closely? Anything that you're liking in this space?
Yeah, so renewables clearly is a space that we like. And we clearly have been evaluating opportunities in the renewable space. Overall, on the whole, we like energy as an opportunity. So we own the largest energy exchange in India. We've just invested into a wind equipment manufacturer. So that's again another one of our most recent additions. So we are very, very constructive. We clearly believe that energy security is a strategic priority for India. And you're going to see massive expansion of capacity happening over the next 5 to 10 years. So in that process, we clearly believe that some of these plays on the energy side are going to end up being huge winners.
Sure. Where does your bias sit in the markets right now? Is your portfolio more tilted towards large caps or broader market stocks, or is it largely a bottom-up approach that you follow?
No, we basically still follow a bottom-up approach. We like the broader market. We clearly believe that there are several opportunities yet in the mid and the small cap space, while of course everybody's been arguing about valuations, but your idea is to find those 20-30 companies in a basket of 3,000 companies where you still see value. So we continue to strive to find bottom-up opportunities in the broader market. We do have about broadly about a 20-25% allocation to the large caps, but it's like kind of a 20-80 or a 25-75 allocation that we have been following.
Very quickly before we thank you, this rounding of the piece on the wind equipment players, because the Suzlon numbers were rock solid. What's the thesis here, and is this a longer term investment bet?
Absolutely, Neeraj. I clearly believe there's a runway of growth for the next several years as far as the wind equipment space is concerned. Second is that this space has become now a duopoly. There are only two formidable or significant players here. So to that extent, it's only two guys who have basically the entire cake to eat. Third is that they have delivered, they've basically raised equity, infused capital, paid off the debt, and pretty much become zero debt or close to zero debt, or at least our net debt zero. So I clearly think it's a combination of all three things which will drive operating leverage and financial leverage and drive earnings as well. So clearly the opportunity looks very interesting.
Okay, Nilesh, great having you. Thanks for taking the time out and joining us. Next time on the budget day, we'll see you.
Thank you so much.